We got one from Graham Stephan here, breaking the largest bubble in stock market history. Let's see what Graham has to say. He's pretty semi reliable, But hey, that's kind of how economics works anyway.
What's up, you guys? It's Graham here, and I think it's about time that we talk about something that probably has crossed all of our minds, and that would be, are we in a stock market bubble? After
Yes, the answer is yes.
all, in the last week, we've just risen to brand new record highs. The Buffett indicator is flashing its most overvalued levels ever in history. Retail traders are once again flooding into the markets, and the AI boom is now officially bigger than the dot-com bubble. Or I guess in other words, the market's currently believed to be grossly overvalued, given that meme stocks are starting to make a comeback and investors are beginning to speculate on anything that they can. So
I don't know why any meme stock has to come into play here. Honestly, what they should be really worried about is how much wealth is centered at the top of the uh, S&P 500. I mean, because even at the top of the big seven, right? There's huge differences in the amount of money that's being shifted in that area.
given the nervousness and excitement over today's prices, we should talk about exactly what's happening, the likelihood of another stock market drop coming sometime soon, and then how you could best prepare ahead of time to make the most of the situation. Because I promise, at some point, there will be another stock market drop and bear market. And even though we can't predict it every single time, if you just know what to look out for, you could potentially make a lot of money. But really quick, if you find this helpful, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. I know it's stupid for me to keep asking for it, but it does help out tremendously.
You know what he said, actually? It does help out tremendously.
And as a thank you for doing that, here's a picture of a hermit crab. So thanks so much, and also a big thank you to the Gemini credit card for sponsoring this video, but more on that later. Alright, so first, in order to understand how to best prepare for something like this, we should first cover the severity of the crashes that have happened in the past. Because even though it's easy to think, this is it, we're at the very peak, I should sell everything before it comes crumbling down. The truth is, market crashes are never catastrophic to the point where you're going to be left with nothing. For example, in terms of the worst stock market collapse, we got to go back to the year 1929. Before
And it really all depends on how diversified your assets are. If you really are holding a lot of S&P 500, it's probably going to be a lot worse for you than if you had shares of, gold or I know there's a ETF that holds like the world's market. Not only American stocks are on it, or they're not. American stocks aren't the only thing that's held inside of that ETF, so it broadens it out quite a bit more. And there's some even that are they take the big seven out of it completely, and you're only putting money into the smaller companies, which in some cases could be a good play, but these big companies are probably going to get bailed out by banks, honestly. Or not bailed out by banks, but bailed out by the government.
At this point, money was pouring out of every crevice, banks were lending out money to anybody who asked, and people, for a lack of better word, speculated too much borrowed money in the stock market because prices just kept going higher. However, once the stock market showed even the slightest glimpse of vulnerability, people started selling, which caused even more people to start to sell, which caused people to withdraw their money from the banks for fear that they would soon go out of business. That led to the stock market dropping 83% over the following 3 years, and the stock market didn't fully recover until 25 years later. From there, in 1945, we saw another stock market drop of 22% as veterans re-entered the workforce, began competing for a limited supply of jobs, and the economy had to readjust without a whole bunch of government spending. Then in the
That was the best time to buy.
1970s, we saw even more turbulent times. Like from January 1973 to December of 1974, the stock market lost over 40% of its value. This occurred when the US dollar was removed from the gold standard, which led to runaway inflation. So in a way to combat that, strict policies were put in place and interest rates were increased to prevent prices from getting out of control, which inadvertently caused the stock market to completely sell off. After that, though, we have the infamous Black Monday of 1987, where the stock market fell 22% in a single day. In this case, a mixture of factors all happened at the exact same moment to lead to a once-in-a-lifetime stock market drop bigger than anything we've ever seen. Then we have the 2001 dot-com bubble. This was caused by a frenzy of speculation towards internet-related companies because that was going to be the future. Well, that was unsustainable, and when a lot of those companies couldn't actually make any money, they completely collapsed or went bankrupt. And if you were invested in tech stocks at that time, you would lose an average of 78%. Sure enough, the market crashes continued.
But like I said before, it depends on how diversified you have your assets. Hopefully you don't have all of your assets into, just tech, because that's a horrible plan.
And in 2009, we had the Great Recession. At this point, banks lent out way too much money to people for mortgages who couldn't afford them. And when those people began defaulting, banks began defaulting. And when banks began defaulting, the entire stock market dropped almost 50%. And once the market had fully recovered, we had the 2020 shutdown. And from the peak, the S&P 500 dropped roughly 30% in value. But before the markets could fall too far, the Federal Reserve stepped in, they lowered interest rates, put together a bailout, and within a month, the market started to recover. However, even though the market proceeded to hit brand new all-time high after all-time high, once the money printers stopped in 2022, stocks began to fall. NFTs, collectibles, and cryptocurrencies plummeted, and at the peak, the S&P 500 was down about 27%. That, of course, brings us to today, because really besides the 20% tariff scare in April of 2025, the market has been on an almost consistent uptrend. So how likely is it that we're currently in a stock market bubble and another drop could happen sometime soon? Well, in terms of how often the stock market drops, it really depends on how much the stock market drops.
I guess he's right. It does kind of depend on how much it drops, but I do feel like there's a very strong likelihood that there is some kind of bubble there, especially in the tech and AI space. Like it's not, fucking Nvidia is not worth that much money. That's all I have to say. They're just not worth that much money.
And the severity of each drop is broken down as follows. First, we have what's called a stock market correction, which is defined as at least a 10% drop in price. Now, it's important to clarify that normal volatility throughout the markets is extremely common. In fact, since the 1920s, the S&P 500 has, on average, seen a 5% pullback 3 times a year. Now, market corrections are also very common too. In this case, when it happens, the average drop is about 15.6% and lasts for 71.6 days. After that, we have a more serious category, which is known as a bear market, defined as a drop of at least 20%. According to the data, this typically happens every 7 to 10 years, and when it hits pretty hard. The average bear market sees the stock market drop an average of 31.7%, and it falls over a period of just over 11 months. Now, of course, it's important to remember that just because these are averages doesn't mean the next bear market will fall exactly in range of this. In fact, we've seen 2 of the shortest bear markets ever in history since the Great Depression. So anything can happen, especially when it comes to third, the stock market collapse. I consider this to be a drop of at least 40% throughout the entire market, and throughout history, as you could see, this has only ever happened 4 times. That's why if you want to protect your money and have the best chance of coming out ahead profitable, no matter what happens, here's what you came for. Although before we go on,
diversify your assets.
That there is one more topic worth discussing, and that would be diversification. In this case, I do my best to analyze exactly where my money is going and where it's best utilized. This means I'm looking at different assets that move independent of traditional markets, and one of the ways I've been exploring is with a small allocation to Bitcoin. However, the problem is that most people overcomplicate it. They wait for the perfect time to buy, or they FOMO in everything because they start getting impatient. That's why I really like today's sponsor, the Gemini credit card, because they're the only instant crypto reward credit card that lets you instantly earn Bitcoin every time you purchase. For example, you could get up to 4% back on transportation, 3% back on dining, 2% on groceries, and 1% back on everything else, which is incredible for a card with no annual fees. In fact, Bitcoin rewards earned and held for 1 year in the Gemini credit card have actually appreciated 176% on average. All you got to do is swipe your card like you would normally, and that's it. Plus, like I said earlier, this World Elite MasterCard has no annual fees, and it comes in 4 sleek stainless steel colors. You have black, silver, rose gold, or
Interesting.
Bitcoin orange. You could also check out the description for more information on rates and fees, or see if you're eligible with no impact to your credit score.
Honestly, kind of an interesting concept. I'm surprised someone hasn't done it sooner. It's probably hard with the regulations, though.
This just makes it easy to gain a little exposure to Bitcoin without having to go and buy it yourself or try to time the market. So if you would like to earn Bitcoin or select from more than 50 other cryptocurrencies that you could switch to at any time, sign up today at Gemini.com/Graham to start earning instantly. And as a special bonus, you could get $200 in Bitcoin when you spend $3,000 in the first 90 days. Again, that's Gemini.com/Graham with the link down below in the description. Thank you so much, and now let's get back to the topic at hand, which is staying profitable. To start, I first want to clarify that I'm not suggesting the stock market's going to crash anytime soon, or that you should sell now and try to buy back in the future when prices are lower, because the chart says it's high. Real talk, if I even had the capability to predict 1 or 2 market crashes in a lifetime, I'd probably be a billionaire. Really, all we know is that it's never a good idea to let hype and excitement lead your investing decisions. And at some point in the future, the market will drop again. We just don't know when. So if you could at least plan ahead for this, it will make a huge difference. Like first, starting out with making sure you have a 3 to 6 month emergency fund. I know I sound like a broken record every time I say this, and
Yeah, I mean, honestly, having an emergency fund is key. I lost my job. It has been 3 months actually, since I've worked, and I'm running out of money. So, yeah, glad I had that emergency fund. I only have 1 more month left. I've been putting in applications, and I'm doing this in the meantime. So we'll see how this goes.
every single video, but it's true. Having 3 to 6 months worth of your expenses saved up in cash is one of the best ways to make it through a market drop. That way, you're not going to be forced to sell your investments at a time when you need them the most and they might be down in price. Second, it's crucial to have a balanced portfolio. The fact is, the more you spread out your money, the more you reduce your risk and volatility. And this is the approach that I've taken. At this point, I have 25% of my net worth in real estate, 35% in index funds spread across the entire world market, 15% in a Bitcoin ETF, and the rest in treasuries. That way, should one market fall, the others should more than make up for it. And if everything goes down in price, I still have my treasuries to buy back in even cheaper. The third, speaking of buying in, keep buying in. Look, I know it's horrible to watch your investments fall 10% in value, and then you buy in thinking you're getting a great deal, but then it falls another 15%, so you buy back even more, and it falls another 10%. I get it, but study after study shows that the best thing you could do is just keep buying in normally. In this case, even though a bear market temporarily loses you 32% in value, a bull market has seen an average gain of 150% and lasts almost 5 times longer at 4.3 years. That, of course, brings me to number 4. Don't panic sell. What I've seen so many times is that the psychology that causes you to sell when your investments are falling.
Yeah, honestly, he's not wrong about that. If you just keep putting your money in, one day it's gonna be high, one day it's gonna be low. And then normally it averages out to be around a 10% gain for yourself. But that's considering that you're putting in the same amount of money over a very long period of time. But if you keep at it, man, then it stacks up. It stacks up quick.
Is usually the same psychology that prevents you from buying back in when things start turning around. As an example of this, over a 20-year time frame, a $10,000 investment in the S&P 500 would have made you almost $65,000 if you did absolutely nothing. But if you miss the top 10 days, which often occur during a bear market, your return falls to just $30,000. If you miss the top 30 days, your return drops to just $11,700. And if you miss the top 40 days, over 20 years, you actually start losing money. This shows you that statistically, the best thing that you could do is just ignore everything and keep buying in normally. That's it. It's simple. After that, though, fifth, keep a steady income. The biggest risk that I see is that if the stock market were to drop, it's usually associated with job losses, kind of like this recent report that we saw. That's why it's so important that if
Yeah, kind of like me who lost his job.
If you could keep your income afloat, you'd be able to buy back into the market during times where it's fallen, thereby increasing your returns. And finally, 6, if you're extra paranoid like me, keep extra cash. I'll admit, according to the data, this is not what you should be doing, but if it helps you sleep at night and keeping more cash on hand is going to help you make better investment decisions across every other aspect of your portfolio, then do it. Oh, and here's an honorary number 7. If you need this money in the next 3 to 5 years, it's probably not a good idea to go and invest it. The fact is, a few years in the markets is not long enough to ensure that you'll actually make money. And
Yeah, honestly, if you're just trying to make a little, hold some value over a short term, you should probably just put it in a high yield savings account and guarantee yourself like 4 to 5%, something like that.
as you can see here, there are times in the markets where you would have lost money even over 10 years. That's why this should ideally be a 10 to 20-year plan, and anything earlier than that is a bit risky. The reality is, if you could just do what I've described, you're practically guaranteed to make money in the stock market over these next 20 years. And I say this so confidently because over a 20-year time span, historically, the stock market has never once produced a negative result. This means that you could literally buy in at the very peak, right before a stock market crash, not make a single investment for another 20 years, and still make money if you do nothing but hold. Separate from that, what most people don't realize is that most likely you're not just making one investment at one time and that's it forever. Instead, you're buying in over the long run, throughout the dips, throughout the highs, throughout the ups and downs. And by doing this, you're going to be averaging out your cost. Of course, if you see your investments drop in price and you stop buying in, yeah, you're going to end up missing out most likely on the best days in the market, and that's going to negatively impact your return. That's bad, but if you could just stick with a plan ahead of time, most likely you're going to be just fine. It's also important to remember that if you're buying stocks, ideally this is money that you shouldn't be touching for the next 10 to 20 years, and whatever happens within that time frame is really irrelevant. Like, you wouldn't freak out if there's a sale tomorrow and the TV you just bought is 50% off, right? Well, the same thing applies to stocks. If you like that TV and it's 50% off now, you might just buy another one. Keep that same thinking towards anything
That's right, man. It's in the red. That means it's on sale. Buy that shit.
with investments. And lastly, let me just say this. As catastrophic as a market crash could be, do your best to reframe your mindset to see this as a huge opportunity, because the reality is, riches are made in recessions. No joke, the best times to be buying in is when everyone else thinks the market's doomed, prices keep falling, and everyone loses faith in the economy and that it's never going to recover. In 2010, this occurred when the real estate market collapsed and there weren't any more buyers for all the homes on the market. In March of 2020, this was the height of the fear, the beginning of the shutdowns, and the banning of travel. But now we're up 110%. In 2022, it was when everyone thought the stimulus bubble was over. But
Yeah, imagine if you bought at the bottom, you know? You buy at the bottom, you're up 110% on your money. You made 110% on your investment if you were investing at the bottom. That's crazy. Like, I mean, you over doubled your money then. I mean, you could have made money. Just saying, I could have made money. I didn't invest.
now we're up more than 80%. In April of this year, it was at a time when everyone was worried about tariffs. Now the market's up more than 30%. You get where I'm going with this. I'm not saying you should wait for these opportunities to happen, but if it does, it's a good opportunity to end up making a lot more money in the long run. On top of that, if you want some more good news, check out Ryan Detrick on Twitter. He recently noted that when the Federal Reserve cuts rates near an all-time high, like where we are now, the market has never once been lower a year later. Again, keep in mind that anything could happen, and 2026 could be the first year this doesn't come true, but overall, staying calm and consistent is going to make you the most amount of money long term. This is also my entire investment strategy over the next few years. I just keep buying in as usual, and no matter what, I hit the like button and I subscribe if I haven't
That's
done
right.
already. So thank you so much. I really appreciate it. If you want, leave a comment down below. I will do my best to read and reply to as many of you as I can. Really appreciate it, and until next time.
All right, man. That was a good video. I'll put a link in the description. Go check us, Graham out if you haven't already. You know, Graham's the GOAT. Have a good one.